Good morning, good evening, good afternoon, traders. As always, thank you so much for joining us here at Trade Delicious. I'm Aaron. I'm super excited to share some more educational content with you guys to make sure you have a full understanding of what's going on in the economy at large. I know there's a lot of charts to look at. I know there's a lot of news to get through, so I'll hop right into it. The subject of the day is ISM Non-Manufacturing PMI. That's a mouthful. Usually it's referred to as ISM PSI, ISM Services PMI. Say that 5 times fast, right? They're basically surveys. It's a collection of surveys that are sent off to purchasing managers in 19 different portions of the services sector. The services sector being a massive part of GDP here in the States and in countries across the globe. Now, this is different than the IHS Market PMI. That's a very, very similar product that's produced by another nonprofit, but they focus primarily in international markets. They do produce a PMI, services PMI, for here in the States as well, but the ISM Non-Manufacturing PMI seems to be the gold standard for us here. This report is really generated from a survey, as I said, and it creates a composite index from the answers on that survey in order to measure the strength of the services sector here in the US. The data that we're pulling from in this case all comes from the Institute of Supply Management. Again, it's just a nonprofit that puts together a lot of these types of numbers for use for companies across the globe focused on the American market. What is included in this survey? This picture really gives you a good idea. You have survey data that is collected by way of asking a question and then having the purchasing manager specifically click one of the 3 answers offered to him or her. The answers that they could have is one of 3 different kinds. They can either have increased, unchanged, or decrease as their answers, or no change now. Or it could be better, worse, or the same. So basically the same types of questions, but after all of these surveys are collected and then sent back to the ISM, they put everything through a diffusion index and add it to a scale that is between 0 and 100. Anything over 50 being expansion, anything below 50 being contraction. Consider that as we continually talk about this product here. It's always really important to go over the basics. I think sometimes when I'm talking to people about this and going over goods and services, sometimes we forget that not everybody took economics in college. Not everyone here even has a college degree, and that's perfectly fine. In order to trade and do well, you need to be good at trading. You need to be good at understanding what's going on in the markets. That's why we're here to help you, right? So, super quick overview. What is a good? What is a service? When you're getting your tires changed, say you need 4 new tires. My wife, she has a 14 Corolla we just got 4 new tires for. When I bought the tires for, the tires themselves were the good. The guy I paid to put the tires on, he was giving me the service, right? So remember that as we move forward, services are really tasks performed by a business for a price, whereas the things like the goods are the tires that go onto the product, in this case, the car. Services as a part of GDP is a huge deal. We're looking back at our friend Fred. This is what a great tool. If you ever get the chance, please take a look at it. From the St. Louis Federal Reserve, they have a ton of incredible data. This is showing what things were like from 2006 to today. And it shows that in 2006, we had some decent numbers. We were a little closer to, say, 11.1% as a portion of GDP for the services industry. Now, services represent 13.1% of US GDP. That's one of the reasons why ISM Services PMI is so important. Now, for the headline number. The headline number in this case really just measures the economic health of the service sector as shown by a percentage between 0 and 100. We've already gone over that a little bit. A reading over 50 is great expansion. A reading below 50, generally speaking, is bad. It means it's contracting. There are 4 parts that are looked at in order to create this top number here. Those 4 numbers being from business activity, new orders, employment, and supplier deliveries. That's how things are broken up into the survey. These four items all play a role in getting us this services PMI. Keep that in mind. Let's look at a quick breakdown to further understand what's going on here. These are the figures that were reported for May 3rd. So this is a leading indicator, but it's talking about what happened in the previous month. So this is the data from April. We had a read of 51.9% versus a forecast 51.8%, really close. Usually economists are like weathermen. It could rain with 100% certainty, or it could not rain with 100% certainty, right? It's always kind of up in the air, so it's always impressive to see them get the numbers right. In this case, this number means that the sector is growing slightly faster than expected, and the additional data that we see is mixed, but things like inventories and new exports stand out. All of these items can mean totally different things depending upon the product that you're trading. If you're trading the US dollar, for example, you want to see things like new export orders not growing 17.2%. This could potentially be bad for a currency because companies could be diversifying their client base. Why would they do that if they're doing so well here in the States? Well, there might be a concern that the Federal Reserve would cut rates, for example. If rates get cut and inflation goes up, the value of the dollar goes down. So it would be in the best interest of a company to go ahead and invest in clientele elsewhere across the globe. So new export orders is something interesting that I'm seeing here that potentially makes this less of a expansion conversation, a positive conversation from an economic standpoint. Another thing to look at is inventories. If inventories are falling, that means that they're selling. That means that the purchasing managers here are excited about selling because they are seeing less inventory. They're getting their stuff off of the shelves. That's really great from an expansion perspective. That's something that we really want to see, inventories contracting in order to expand on profit margins. This is something that's really great to look at if you're trying to make a play on the manufacturing sector. Stocks like Home Depot, Honeywell, Procter & Gamble, as I spoke about before, are going to be big players in this area. So if we continually see stuff like inventories falling and business activity growing, then more money is going to be made. Let's look a little bit further into how to analyze this stuff. Always remember that the interpretation of this data depends on the current economic conditions. Here in 2023, things are a little different than they were in 2007, and vice versa, right? These surveys are leading indicators, meaning that they're setting an expectation. They aren't the real deal. We have some real data that comes out from the U.S. Bureau of Labor Statistics, as well as the Bureau of Economic Activity from the U.S. government that gives us a very clean idea of what's happening in the manufacturing sector. This is just giving us a sneak peek, and it helps investors and business owners, traders, to plan and anticipate the numbers that are going to happen. It's one of the reasons why we use indicators, one of the reasons why it's such a big deal. A lot of people feel like it helps them get a leg up on the competition. Always focus on the bigger picture and remember what lens you're seeing this through. It's sometimes hard to understand which way is up from that perspective because, normal economic conditions, expansion's great, more money's great, and contraction's bad, less money's bad, right? Sometimes. Especially when we're seeing mixed figures like that report that I just showed you guys, where you had things like inventories going down, but new export orders going up. That could be really great for Honeywell as an individual stock if they're diversifying, they're selling their stuff. But that may not be great from the perspective of a currency trader. An equities trader would be able to grab onto some of those gains potentially by buying some manufacturing stocks or a manufacturing index, whereas someone who's trading the US dollar could also benefit by doing something like buying the pound dollar or shorting the pound yen, something along these lines. Remember that there are so many different ways to approach these things depending upon the asset that you're trading. Let's look at a couple examples to get a further understanding on how it affects economies as a whole, though. 2010 is an interesting year for us here in the States because we're coming out of the craziness of 2008, 2009, and we're starting to recover, right? So a positive and expanding ISM services PMI would be great. That type of growth is what we would need at that time because we were a country trying to get back into the saddle after the craziness of 2008. In contrast, let's take a look at 2023. What's the focus right now? Inflation. If anything grows, if any business activity grows, generally speaking, inflation also grows. So what will we see if PMI continually grows, services PMI continually grows? We'll see the Federal Reserve take action. If the Federal Reserve takes action by raising interest rates, that'll make money more expensive, that'll make it more difficult for companies to spend the cash they want to spend to expand. People will lose their jobs, and the economy most likely will contract. In this case, of course, all those things are incredibly negative, but from an economic standpoint, the US dollar would grow stronger in this scenario, even though we would be experiencing potential contraction from the Federal Reserve's actions. This is the same situation from an economic standpoint as 2010, when you're solely looking at whether or not an economy is growing from a positive or negative ISM services PMI. In this case, a positive PMI means we take very little action from someone like the Federal Reserve. They're not caring so much in 2010 about this issue. They're trying to get people jobs. They're trying to make sure everything is stable. The Federal Reserve in this case is taking the absolute opposite perspective, and they're causing the economy to potentially shrink, GDP to potentially shrink. But in both cases, the US dollar goes up in value. Remember that as you're thinking about how you could potentially take advantage of things by way of using these events to further understand the macroeconomic landscape. Every report that you see is a part of a much larger whole. Boom! That's really all I have for you. Thank you guys so much, as always, for watching these. We love to share everything that we know with you guys concerning the economic situation, the macroeconomic situation in the world, and we hope you got some value out of that. As always, get out there, trade well, and trade delicious. I'll see you.